Hello, bonjour, miigwech, and konnichiwa. Welcome to Wading Through Economic Filth, or Wealth of Nation, where I seek to explain things going on in the Canadian and global economies. I'm Greg Quinn. I've spent the last 2 decades as a business reporter in Ottawa. I'm trying to merge that experience into this evolving world of media tech in a world of rising disinformation. I also wrote a book, which you could see over my shoulder, about the work of Canada's central bank. Inflation and affordability have dominated society in the last few years. The Bank of Canada is a big part of the picture when it comes to these topics. Today, when I'd like to talk about some of the arguments around cars and tariffs, you may have seen Donald Trump has threatened Canada and put automobiles at kind of the center of his grievances. For me, as an economic watcher, this quickly gets into questions about the production capacity of automakers in Canada and the U.S., the overall Canadian trade balance with the U.S., labor costs, and robotics within the auto industry. Many of these arguments about autos also apply to aluminum and steel industries that are also facing big tariffs. I'm going to take a bit of a scattershot approach. Some of these things are all over the place, but that's also the kind of dialogue we're seeing lately. The first argument is that President Trump designated cars for tariffs under a national security law. I mean, when you just think about that on its face, automobiles have been around for more than 100 years and are civilian devices. While you could make the case that the cars we're seeing now with all these connectivity features and data collection are potentially a security risk, but Canada is a military ally of the US, and we often set auto standards together on things like emissions and other standards. We just haven't seen any comprehensive standards on these kind of data security questions yet in any case. President Trump has also suggested that automobiles are a big driver of the trade deficit that the U.S. has with Canada. In fact, if you look at some research from Bank of Montreal, they've shown that more often than not in recent years, Canada has run a deficit in automobiles and parts with the U.S. That simply reflects some of the headlines we've seen. Canada has lost some significant assembly line production in the last few years. Economists I've read also point out that the U.S. in fact needs to import several million cars a year to meet its demand. And that's beyond America's own internal production capacity. While Trump has said that tariffs will help rebuild the U.S. auto industry, getting that kind of production capacity in place would clearly take years and would probably leave American consumers with a shortage at a time of affordability concerns. Furthermore, what struck me in the last couple of years is that both the Joe Biden and Donald Trump administrations cheered on as the United Auto Workers negotiated very large pay raises with the major automakers. So if America expanded its production and filled all of its automobile needs domestically, the costs would be much higher. And that's not just on the absolute wage rate in the U.S. There's also, of course, the discount of about 25% on Canadian imports simply because of the weaker Canadian dollar. And we already have lower hourly wage costs here and free healthcare benefits. And, what's the labor costs in Mexico are even lower. Another idea that's been kicked around is that putting tariffs will mean jobs come back to America. But my understanding is car production has been becoming more automated and robotic for a long time now. And you could see how the AI revolution could automate it so much more. So if firms do build new auto plants in the US or even in Canada or Mexico, it seems likely they will use as much automation as possible. In other words, create as few jobs as possible. And again, what I just said about wages rising significantly in the US, this is just standard economics. If you raise the cost of labor, companies will seek to reduce their overall costs by using more capital. Finally, would you add in the fact that the U.S. has put major tariffs on steel and aluminum from Canada on top of that, the cost of producing a car in the U.S. will go even higher if the U.S. imports any of those materials from Canada to produce cars in the U.S. Again, if you just listen to what Quebec aluminum producers are saying about the U.S. market, they have said that they're millions of tons a year short in their own production of what they are using. So, again, the U.S. could perhaps rebuild its aluminum and steel industries, but that would take years. And in the meantime, of course, consumers there will just be paying higher tariffs. More broadly, what is odd about Trump's strategy from an economic point of view, or even a broader point of view, is he talks about wanting a deal invoking security and trade, but he already had that with Canada between what used to be called NAFTA, or is now USMCA, and the NORAD agreement, and other forms of cooperation. He already had significant trade and security with Canada. Of course, it appears that politically he wants to talk about extracting more jobs and investment from Canada. But again, you could see from what I've said, this potentially will backfire. Canada, of course, has also gotten the message and has moved to reshape its trade to boost its exports to countries like China and India. We are already seeking to send oil and natural gas there, and food and other commodities are going to follow. These are products we used to send to the U.S. Trump has made this argument that Canada is ripping off the United States, but in fact, a large share of Canada's exports have always been commodities, and those tend to trade on global markets and are priced in US dollars. In other words, Canada has almost no leverage or power to manipulate prices or quantities it sells to the US. You know, if Canada set a higher price for a 2x4 than the global price, it would very quickly becomes obvious, and the U.S. would have the ability to import from another country, and that is the same for products like wheat or oil or natural gas. What the tariffs are doing, as I mentioned, is forcing Canadian firms to look at selling into markets that are farther away. So what this does is it raises transportation and logistics costs. So Canadian firms certainly are losers in this situation. But the U.S. also loses out on the ability to buy the best goods at the cheapest prices. Finally, in terms of any trade deficit the U.S. is running with Canada or other nations, again, standard economics gives you a pretty easy explanation. We often talk about demand as being partly driven by incomes. American consumers have the highest incomes in the world. So when it comes to trade with any given country, it stands to reason, because of higher American purchasing power, Americans are going to purchase more goods from other countries than vice versa. That is not a complicated concept. And economists have also pointed out that the share of consumer spending as in the overall total U.S. economy is much higher than in most other of its industrialized peers. So in other words, even when America trades with other rich countries, the fact is American consumers are spending much more out of every $100 of GDP in the U.S. than other countries. So there's a natural imbalance there that has nothing to do with the trade practices of Canada or other U.S. trading partners. To make this a little bit personal, I grew up in Nova Scotia, and I'm quite sure that if other things were equal, fishermen would not be selling their best lobsters and scallops to Manhattan bistros. We would be eating more of them here in Ottawa, in Toronto, in Montreal, and in Halifax. If you read a book called Cod, I remember quoting a fisherman from Iceland, I believe, saying something like, "You don't eat money." In other words, you sell the best stuff and you eat the rest. So, more broadly, a big reason economists believe in free trade is one concept called comparative and absolute advantage. The idea here is that in any economic system where people have different skills and different products to sell, there are always gains from trade. If Canada has a lot of trees and America has a lot of factories, Canada selling trees to the U.S. and buying back, say, manufactured wood products means both countries will benefit from producing more of their best products and trading them. That's the easy case. That's the comparative advantage theory. There's also a theory that looks at what's called absolute advantage. Let's think America first here. If it is true that America is truly the best at making absolutely everything, there are still clear gains from trade if other nations still focusing on producing what they're relatively best at and trading for the rest. So if America can make a garage door for a house for $500 and they can make a wooden table for $200, let's say Canada can make a garage door for $1,000, so twice as much as the U.S. price. And let's say Canada can make a wooden table for $300. In total, we're better off if Canada just makes tables and sells them to America in exchange for garage doors. The overall cost of producing one garage door and one table is now lower than it would be if we made them separately. So the savings is another question. Typically, you might think that in standard bargaining, you might share those gains from trade equally, but you don't necessarily have to do this. But there is no question that everyone will still have significant benefits from trading, even if you believe that one country makes everything absolutely cheaper than another. So is Trump in effect arguing that he wants to extract more of that value from trade? Is that what he's really saying when he's talking about striking a deal or passing on deals on trade? That seems obvious when you look at it from an economics point of view. But as I've said, putting up these trade barriers will create costs in terms of trade realignment. Again, Canada looking to move some of its products to other countries, and the tariffs might cost consumers. And if you rearrange industries that are already working to a competitive advantage, shaking up trade does not really carry the benefits that you might think it would. I'd like to end on another issue. Donald Trump has said the U.S. trade deficit with Canada is around $200 billion a year. That's a figure that's just highly exaggerated. He's also said that Canada is a major source of fentanyl and illegal migrants. And that's one reason he's using this trade dispute as leverage to get concessions there. But some data from U.S. federal departments show that Canada is less than 1% of those flows of migrants or illegal fentanyl. But who's counting? Before I go, I'd like to recommend a book that does rely on looking at numbers and facts, but it's a fairly intuitive read. I'm quite affectionate of this book. It is called A Mathematician Reads the Newspaper by John Allen Paulos. It digs a lot into some of the mathematics and science of economics, but in a very illuminative way. It's fairly fun and it's fairly easy to read, and it will connect you to some big ideas. Anyways, that's all for today. Thanks for watching. Goodbye.